Interest rates are surging, but is this time different? That's today on 3 Minutes on Markets and Money. Lots of conversation here recently about the surge in interest rates. Now, importantly, we need to keep interest rates into some level of perspective because interest rates have indeed risen sharply over the course of the last couple of months. In fact, if we take a look historically, this is one of the largest drawdowns in bond prices or one of the largest increases in rates that we've seen in quite some time. And that's, of course, putting a lot of angst on the financial markets is that, oh my gosh, is the bond bull market finally over? The bear market in bonds is finally here. Lots of headlines about that. But is that really the case? First of all, we have to talk about interest rates and the psychology around interest rates. Interest rates are only back to where they were in 2019. Economy was doing fine, at least so we thought. We hadn't got into the 2020 pandemic shutdown yet. Markets are doing well, and of course, housing's doing well. We're buying houses. We're talking about a shortage of inventory in housings in 2019. And yet today, interest rates are back to where they were then, and we're talking about people being shut out of affordability of owning a house because of where interest rates have gone to just over the last 3-4 months. The only reason these people could afford a house 3, 4, 5 months ago is because rates were so exceptionally low. But in an economy with as much debt as we currently have, rising interest rates are problematic because of the impact of using debt to foster consumption within the economy overall. Higher interest rates have two impacts on consumers. One, interest rates go up, they can't afford to buy more stuff, so they contract their spending, leading to slower economic growth. The second thing is with higher rates is there's a psychological change to consumers at that point. They're going, well, interest rates have gone up. Historically, interest rates have always come down, so I'll just wait to buy whatever it was until interest rates come back down again. That waiting to make consumption also leads to slower economic activity. Historically speaking, when interest rates get more than 3 standard deviations oversold, which is where we are currently, that has typically not only been the peak in interest rate movements for that cycle, but it has also led historically to problems elsewhere in the financial markets. In fact, the last time that we were this overbought in terms of interest rates was, guess where? In 2020, just before we had the pandemic shutdown. And this was because the Fed had been hiking rates leading up into this period. And then, of course, once we had the economic shutdown, interest rates fell to basically about 0.5%. Prior to that, of course, we go back to 2008. Interest rates were peaking out at 3 and 4 standard deviations above the moving average. Of course, by the time we got through the interest rate cycle, interest rates were back to very, very low levels. 1994, of course, we got back up here. This was the bond bear market that we saw back there. It was the bond crash of 1994. All through history, the point is that every time that we have gotten to very overbought levels in interest rates, no matter at multiple levels, dot-com crisis, Asian contagion, we saw this in the Eurozone crisis as well. Rates tend to peak out at that point. They cause economic problems somewhere within the financial system, and that leads to lower rates in the future as there is a risk-off movement in the markets and in financial systems. And again, this will probably be the case here again. As the Fed is now trying to hike interest rates and slow economic growth, interest rates themselves have already been tightening monetary policy. As I said, housing is already starting to show signs of weakness. We're seeing consumption slow in other areas of the economy. And as we begin to get in more trouble here, economically speaking, likely these higher rates are going to cause some type of crack somewhere in the financial system. That's going to lead to that risk-off rotation from equities back into bonds for safety. And this will drive rates most likely back down to the previous lows, if not lower this time around. So we'll see when we get there. Be careful with what you do with interest rates. And by the way, interest rates spiking like they are now have been the best buying opportunity for bonds that we've seen historically all throughout the market cycle over the last 40 years. That's 3 Minutes of Markets and Money. We'll see you next time.